Most people believe their money is safe. They believe it is stored, protected, waiting quietly in a bank vault. That belief feels logical. It is also incomplete. In this episode, we look at how modern banks actually work, where deposited money really goes, and why trust, not cash, is the foundation of the entire banking system. From an early age, we are taught a simple idea. You work, you earn money, you deposit it in a bank. The bank keeps it safe. The building feels solid. The brand feels official. The app shows a balance. Everything appears stable. But banks are not storage buildings. They are financial intermediaries. Their job is not to hold money. Their job is to move it. Modern banks operate using something called fractional reserve banking. This sounds complex, but the idea is simple. When you deposit money into a bank, the bank keeps only a small portion of it available as cash. The rest is lent out. For example, if you deposit £1,000, the bank might keep only £100 available. The remaining £900 is loaned to someone else. That borrower spends it. The money enters the economy, and it often ends up deposited in another bank. That second bank keeps a fraction and lends out the rest again. One original deposit now supports multiple loans. Fractional reserve banking was created to support economic growth. It allows money to circulate. It allows businesses to expand. It allows homes to be purchased. It allows economies to grow faster than cash alone would permit. In normal times, the system works. Depositors do not all withdraw money at once. Loans are repaid. Confidence holds. The system depends on balance. Not everyone asking for their money at the same time. Here is the part most people never learn. Banks do not lend existing money in the traditional sense. When a bank approves a loan, new money is created electronically. The borrower sees a balance appear in their account. That balance did not come from someone else's savings. It was created by the loan itself. This means most money in the economy exists because someone is in debt. Money and debt grow together. They cannot be separated. Because banks lend out most deposits, they cannot repay everyone at once. If many people demand their money simultaneously, the bank does not have enough cash. This is called a bank run. Bank runs are not caused by irrational fear. They are caused by a sudden loss of confidence. Once people believe a bank might fail, speed becomes the danger. The first people to withdraw succeed. Those who wait may lose access. That is why trust matters more than numbers on a screen. During the Great Depression, thousands of banks failed. People lined up outside branches. They demanded their savings. Banks closed their doors. Deposits vanished. This led governments to introduce deposit insurance, not to change how banks operate, but to restore confidence. The structure stayed the same. Belief was repaired. In 2008, confidence collapsed again. Banks had taken large risks. Losses spread through the system. Banks stopped trusting each other. Credit froze. Governments stepped in to prevent total collapse. Banks were rescued not because they were harmless, but because the system depended on them. After 2008, the phrase "too big to fail" became common. It means this: some banks are so interconnected that their failure would damage the entire economy, so they are protected. This changes behavior. Risk feels safer. Losses feel distant. Confidence becomes dependent on intervention. The illusion grows stronger. Your bank balance is not physical cash. It is a claim, a promise, a system based on confidence. Most of the time, that promise holds, but it only holds as long as trust remains. Understanding this is not about fear. It is about awareness. The banking system is not built on vaults full of cash. It is built on trust. Trust that loans will be repaid. Trust that confidence will remain. Trust that support will appear when needed. This illusion has worked for decades, but like all illusions, it depends on belief.